Good afternoon, everyone, and thanks for hanging out until the lunchtime to hear our sort of a business idea and what we are doing. But as an introduction, I am Surat Maheshwari. I run the capital markets team at Prysm. Together with me, joining over Zoom is Ari Stiegler, who is the CEO of Prysm. And just as a way of introduction, Prysm is essentially a fintech platform. We are based in Los Angeles. And we've been up and running since 2021, and we are basically funded by a pretty prominent venture capital based on the West Coast. What essentially we are doing at Prysm is solving for a very big issue with respect to the shareholders of the unicorns. And just to define the term unicorn, unicorns are the private companies which are VC backed, but their valuation is more than $1 billion. And the reason there is a big issue, particularly in the VC world, is that literally at this point of time in the US, there are almost 600 unicorns, and their aggregate valuation adds up to almost $2 trillion. And
these are all private?
These are all private VC-backed companies, almost 600 of them in the US. And so, when I use the word unicorn, essentially what I'm saying is that all of these companies, VC-backed, whether they're in the healthcare or fintech or the insurtech space, but they have achieved the valuation of $1 billion, which literally takes 5-6 years on an average for these companies to get to that valuation, meaning that the VCs have deployed hundreds of millions of dollars in those companies to get to that valuation. Now, the issue that a lot of unicorns are facing is that they have a lot of employees, a lot of early investors, founders, who are very, very vested in the company, meaning that, for example, if I am a software engineer working for a fintech company, I've been there, paid my dues, and all of my, a lot of my compensation comes with respect to the stock in the unicorn, like a private stock in the company itself. And by the time I'm in my year 5 or year 6, I'm completely vested into the stock of the company. So when I look at my statements, I feel pretty wealthy. The company valuation is $1 billion. I'm sitting on a lot of wealth, but I don't have a liquidity. I'm still earning basically the paycheck, month to month. And, if I wanted to make a down payment for a house, how do I do that?
Stock rich and cash poor.
That's exactly right. Stock rich and cash poor. So that's kind of where we come in, is that we're trying to solve this problem, is that, look, how can we give liquidity to the shareholders of these 600 unicorns in the US who are sitting in a massive wealth so that, they can kind of go make a down payment for a house or buy a good car or whatever they needed to spend their monies on. So that's kind of what our overall approach is, particularly in this space. So I think, as I mentioned, in the public market, it's very easy. I mean, you can go and get a margin loan, from somebody in the public markets. And to give you a data point, in the public markets, the margin debt is almost like $1 trillion at this point of time. And in the public markets, the total capitalization of the US equities is 50 trillion, and there is a $1 trillion margin debt in the public markets available. So there is a solution very, very readily available in the public markets, but there is no equivalent solution in the private market. And we have $2 trillion worth of market capitalization in the private market, but there are no sort of an equivalent product that you could give liquidity to a private shareholder. And that's basically what Prysm is trying to solve for. So from our perspective, we see a pretty big market opportunity in this market space, because ultimately a lot of the players in the industry, whether they are the employees or they are the founders or they are the early investors, they are actively looking for some sort of a liquidity. And the recent sell-off in the market is not helping, because if you can imagine, you're an employee and ultimately you're waiting for a big payday that comes when there is an IPO or an M&A event. And on an average, by the time a unicorn goes through an IPO, I think typically it's 12 years by the time they get to the IPO. And therefore, they need this liquidity at this point of time. So that's essentially, we see a big market opportunity. And the challenges in this market are sort of from the borrower perspective, is that there are a couple of challenges. First of all, how do I find the liquidity? Now, the one option that they can always exercise is to sell their stock outright, but then you have a lot of tax implications. Just because your cost base is so low, you've been with the company from the beginning, and selling your stock to another party to get that liquidity just creates a massive tax bill for you. And therefore, a lot of your upside essentially goes away as well, because you are no longer the holder of the private stock, and therefore you don't have any upside on a go-forward basis. So there are a couple of challenges from a borrower perspective that we are also trying to solve for. Now, what this challenge has done is that it has created an opportunity for the lenders in this space who can provide a loan to, let's say, a borrower who's out there. He has got a vested stock into the company, which is valued in a couple of $1 billion. And essentially, what a lender can come in, or that's kind of what Prysm does, is that we make a loan to that particular borrower. So imagine I am a software engineer, and my stake into the unicorn is worth $1 million. I can actually go to my Prysm platform, give all of my information, and Prysm can actually give me a loan at a very low LTV. And typically in this market, given what's going on, I think we want to be very conservative because ultimately we are a lender, and therefore we want to protect our principal and all of the repayments. So our typical sort of a LTV on our product, it's like a 3-year loan. Typical LTVs of, call it like around 15%, 20% area, depending upon the type of unicorns we are dealing with. And then ultimately, we are able to sort of generate overall return to lenders to Prysm. So initially, it's just like a consumer platform. The borrower would come to our platform, we would make a loan, and in turn, we would go and sort of develop a partnership with potential lenders to sort of fund Prysm. And the net return on this product that we can generate for lenders is, call it like in low teens area. So ultimately, what's our product? We basically give like a 3-year loan to the shareholders of a unicorn, and we take their vested stock into that unicorn as a collateral at a low LTV, call it like 15, 20% LTV, and we generate something like low teen returns for a particular lender. At this point of time, at Prysm, we have a number of unicorn partners already. I mean, we just got started in 2021, and we already have a number of unicorn partners. And when I use the word partners, we would have an agreement with that particular unicorn at the board level, where they would sort of authorize that we can get the commons or the stock of that particular unicorn as the collateral, meaning that we want to, as a lender, we want to make sure that we have the collateral. So we would literally get possession of the collateral. There would be no sort of legal issues in terms of the security perfection issues. And not only that, we would also make sure that in the private shares space and like the public markets, depending upon the articles of incorporation, you may have some transfer restrictions at the unicorn level. So we are solving for that as well, meaning that as a lender, if we need to exercise the remedies, which would include liquidating the collateral, that we should be able to do it. As a lender, we should be able to sell that collateral and get our money back. So we're going to make sure under that agreement with that unicorn that there's security perfection issues are taken care of, that any transfer restrictions are taken care of. So we will have a sort of a pretty formal agreement with the unicorns. But coming back to my point, I think at this point of time, among the unicorns that we have on our platform, their aggregate valuation is approximately, so to speak, in this market, call it like $40 billion. And so even if you were to do like a back of the envelope calculation, we already have like $1 billion worth of demand on our platform right now. So there are people out there who would want to borrow. The unicorns have signed up to our platform, and therefore we are actively looking for lender partners who can kind of work with Prysm to sort of put their capital out to work. And I think, as I had mentioned, returns somewhere in teens area. You're fully protected by the collateral. Your loan to values are pretty low, 15, 20% area. Now, the question that comes up from a lot of lenders that we are sort of talking to right now is that how do you define the V in LTV? And therefore, obviously, there are a number of ways to come to grips with what the valuation should be, even in the private market. Public markets, obviously easy, you look at the stock price. But there is a sort of a number of platforms out there in the private shares space, which are sort of trading the stocks of these unicorns. So there are platforms like Forge, like Zenbaro, Nasdaq private markets, Carta X. So you can actually observe, particularly in the unicorn space, because these companies are much larger, meaning that they have the valuation of more than $1 billion. So you can literally see what the trading level has been in the past 2 or 3 years, or how that trading levels are evolving. So that's kind of one way to sort of put a number out to their valuation. Obviously, you have access to their last valuation round that they did. There is a number out there, dollar per share. And then obviously, number 3 is that we can always do a public market comp. So for example, if a unicorn is in the payment space, we can kind of create like a universe of the public companies who are also in the payment space, and then we can kind of track the valuation of the private unicorn versus what's going on in the public market. So we can kind of come up how to handle the valuation part of the LTV, and all of that work we have already done at Unicorn. The second thing
do you ever just buy the equity at a massive discount, or are you always just lending?
We are always lending. The issue with buying equities at a massive discount is also, I think there are some of the platforms who do that. But our sort of a motto is that we want to be very, very systematic about it. Our product is a lending product. We want to be very, very borrower friendly, because when you are structuring it as a lending product and being very conservative in terms of your loan to values, as I had mentioned, in 15 to 20% area, the borrower sees the merit in it because he is still the owner of the stock. Because ultimately he's waiting for the IPO day, right? That's kind of when he's going to cash out a big time, right? So he doesn't want to sell it, like if he doesn't, unless there is a push comes to shove type of a situation, right? And then the second thing from a borrower perspective also is that anytime he's going to sell his share, his cost base is very low. And therefore it creates a big tax headache. I mean, you may end up paying 40, 50% in taxes alone if you were to sell your stock. Whereas a lending product makes a lot more sense from his perspective. He gets the liquidity, and at the end of the day, he's still holding on to his stock. Yeah.
So you talked about valuating these private companies. Do you rely on 498?
Yes.
Is that useful?
Yes. I mean, clearly, I think as happens in any public markets or in any M&A transaction, you always look at the valuation in like 3, 4, or 5 different ways. But ultimately, it comes down to a judgment call. Right. So the way it would work at the Prysm we work with it is that, look, if there is a good amount of liquidity in that particular name, that to us is the most strongest sort of a number with respect to the valuation. But let's say there's not too much of a liquidity in a given name, then obviously we'll look at the public market comps, we'll look at the 409A valuations, a number of other techniques to sort of really figure out what the value should be in the LTV calculation. Yeah.
Do you take into consideration like time to IPO or buyout?
We typically are working with the companies which are in like series, E, F, G. I mean, that's kind of typically how when they get to a unicorn kind of a valuation.
Understood.
Yeah, but kind of yes, we do take that into consideration, and by and large, I think we are hoping that those companies would have an M&A event or an IPO event in the next 3 years.
3 years. Okay.
Next 3 years, yeah. So
what's determined the loan?
It's 3 years. It's 3 years. Yeah, yeah, and yeah, I mean, 3 years is a number. I think that's kind of there are a number of options we can also exercise at the end of the 3-year term in case there wasn't an IP or an M&A event. So there's a whole lot of a back end sort of analysis that we have done, that how can we handle the situation in a scenario like that.
Are there warrants built into the loan, or it's just straight up?
It's a sort of for the most part, the returns to a particular lender who's working with Prysm mostly would be in terms of the coupon. But we are really solving for, and we can structure the sort of the return to any particular lender in a number of ways, including, so to speak, like a warrant position. But ultimately, what I'm suggesting is that the returns that we are solving for to any particular lender, call it in like teens area. So now that can be a combination of some upfront fees. It could be a combination of a regular interest payment. It could be a combination of some sort of an upside. So we have different levers to sort of structure a particular return for any lender.
What's the size of the coupon typically?
The coupon typically, I think we would be solving for is like around 12% per annum.
That's returned to
the lender,
to the fund, or to the investor?
to the lender, to the Prysm, or who the Prysm is working with as a lender.
So are you structured as a fund, or are you an intermediary?
No, so we are. So any consumer who comes to our platform, Prysm technically would be making the loan, and there is a bank in between for regulatory purposes, lender of record sort of a concept. So the loan agreement is between Prysm and the borrower.
Okay.
In turn, we would turn around and we can put all of these loans, this portfolio of loans, in a SPV and get.
I got my question.
Right, and then get some lender to fund us using securitization concept, or just buy the loans from us outright. So there are a number of ways we can structure the transaction with a particular lending partner for Prysm. Yeah.
Okay.
The one thing I also want to point out is that we are working, when we are making a decision which unicorn to work with, clearly we kind of want to make sure that there is a liquidity on that name. We are sort of want to make sure that we have a crystal, clarity into the sort of their capitalization table, because we do want to make sure that as a lender to any borrower, that I really can make sure that the shares in fact exist and they are recorded in the records of the company. So we want to make sure that we have the full access to their capitalization table. We are working only with the US companies right now. We want to make sure that they have enough cash for the next 18 months or so, that particular unicorn. We also want to make sure that they have a certain minimum EBITDA or certain revenue run rate. So the way we are attacking the unicorn side of the equation is that we are being sort of a very cognizant is that, look, we got to go after the quality unicorns and therefore sort of protect our investments through that way as well. Now, this product makes a lot of sense. I mean, the VC community is very, very supportive about it because, as you can imagine, who are the owners of all of these unicorns? These are prominent venture funds in the country, right? So they are very, very supportive of this agreement because ultimately it comes down to sort of aligning the interests of the employees as well and helping employees get some liquidity. So the VC community is sort of a very, very supportive of all we have done sort of in this space so far at Prysm. The one final comment I would make is about this particular asset class. Now, the question always comes up, I think all of us in this room, whenever we are looking at a situation, the question always comes up is that, okay, how do you sort of model the risk in this product? Because ultimately what we're really talking about is lending against the value of that particular share of that unicorn. And, so the example I say is that, yeah, I mean, there are ways to do it is that because there is a lot of data available in the unicorn space. I can go back in history, past 5, 10, 20 years. I can dig out every single unicorn and I can look at the data, how many unicorns just went under, right? Because that's a complete loss in our, because we are lending against the unicorn stock, right? And the other risk is that we can also think about it is that what if that particular unicorn happens to have a down round? Because ultimately what that does is that our LTV in that scenario has gone up because the valuation has a down round. We gave we gave a loan assuming a certain valuation, but the next round was a down round and therefore, the LTVs has gone up. So that's a risk factor. So we literally went back and we sort of ran the analysis on a portfolio basis with respect to what the loss rate would be in this particular asset class. And the number, and we can kind of share all of this information with you if you were to reach out to us on a one-on-one basis. The loss rate that we came out is like approximately 2% in this particular asset class in the unicorn space. And the returns that we are solving for, as I had mentioned, is in low teens area, so call it like 12-13% return. And we can kind of compare this particular asset class to the high yield market, which have a lot of data points available. So just looking at the US high yield market in the last 3 years, the sort of the default rate in the high yield market, I think on an average is like 3% in the last 3 years. And the return, I mean, obviously the high yield indexes have sort of not performed well in the past couple of months, but on an average, the high yield index has returned like around 5.5% in the last 3 years on an average. So when I compare the product that we are putting together versus the high yield market, our product is like 2% loss rate based on the historical analysis. Returns in the teens area, whereas the high yield product, loss rates in 3% area, returns in 5 or 6% area. So, and the reason that makes sense also is that clearly it's a new product, not as well established as the high yield product. There are sort of illiquidity considerations, so you need to compensate a lot of lenders for the illiquidity risk. So I think that's kind of how we are sort of thinking of approaching this particular product. But I think stepping back a little, I think the big message over here is that there is a tremendous need. I mean, there are so many employees out there working for these 600 unicorns in the US, sitting on a massive wealth, and they need some liquidity solution. So there's a massive need out there. And I think
only US, only domestic unicorns.
Correct. So far, it's only US, and I think as we grow, obviously we'll expand to Europe and other jurisdictions. But for the starting kind of a couple of years, we are just 100% focused in the US market, just because the market is so massive to begin with in the US itself. And we already have like $1 billion worth of sort of potential demand on our platform as of today.
I only have a few minutes left, so we'll want to answer a question.
Yeah. So are you guys the custody of the shares, or do you third-party custody? And then my follow-up is like, how do you deal with like right of refusal on certain shares, and do you get access to board meetings to make sure if they're changing the share?
Yeah. Right. So 3 questions, I think, in your remarks. The question number 1 is that yes, we do take possession of the collateral. So I think, as you know, most of the unicorns, typically tend to use platform like Carta, where sort of all of their shares are held, and we basically just get the transfer of the shares in our account at Carta. So basically, yes, to answer your question, we would hold the collateral as a lender. We want to hold the collateral. I think I forget your second question was. Right. So yes, so we do solve for it. So whenever we sign up a unicorn, we actually go and make sure at the board level and working with the C-suites that there are no restrictions as when it comes down to exercising the remedies, which includes our ropers as well. That look, as a lender, we are providing an employee incentive at the end of the day, right? Aligning the interests of the employees with the unicorn, and therefore we need whatever remedies when push comes to shove we need to take. We need to make sure that we can exercise it. So we solve for it on day number one. And they have to kind of make those changes in their operate, at the articles of incorporation or whatnot. Yeah.
Lenders recourse.
These are non-recourse loan. Yes. So these loans are nothing to do with the FICO scores, but as you can imagine, it's all about loan to value, the value of the collateral. And that's the reason when I talk about 15% LTV, there is a reason for that, because these are non-recourse loan, because ultimately we went back in history, looked at how the unicorns have performed. We want to be very safe about it. We realize that the market is illiquid. So when it comes down to exercising our remedies, if we need to liquidate the collateral at a 20% discount, we want to do that. And that's the reason the risk management tool over here is to set the right LTV, because that's kind of how we will make sure that we get our principal and any interest back.